What's going on, guys? It's David here, and today we're providing you with a brand new commercial real estate transaction, which I'll be underwriting down in Excel, uh, just one-stop shop, full on stream, no cuts, and you'll be following me along the way, and hopefully you'll be able to underwrite your own real estate transactions. This will be perfect for you if you want to get into a real estate private equity analyst job, prepare for an interview, or even start underwriting your own deals, start making some transactions on your own time, or even getting equity capital partners or even debt capital partners for your own transactions. And if you want anything more of this, just provide some details down below, and I'll show you just how to get it done. So my name's David. I'm working as a private equity real estate analyst here in the Nordics, and I do the underwrite these transactions a lot in my work, and I want to share it with you guys. So let's begin. Okay, so what is going on, guys? We're back here, right? Jumping right into the modeling. So we're looking at an investment memorandum, which is kind of a thing that broker sends out. That's usually a PowerPoint, and they're presenting a selling opportunity, a unique opportunity always. Okay, and I wanted to underwrite a real investment such that you can take this home. You can do this for your own local deals, which you might source from the listings, or talk to brokers, and they'll send these kind of memorandums out. You can also use this at a job interview where you this is actually what you do as a investment analyst at a kind of real estate firm or private equity firm working in real estate. So let's jump into this beautiful investment opportunity. This some type of a multifamily unit where it looks a little bit dull, I'll be honest, but probably quite high yielding and where money can be made. So let's get into the details. So you can read up on it here. I'll copy the link down below. It's 19 units. They talk a little bit about the location and about the business plan and they present it as a value add opportunity. Obviously, it's quite an old property. Here they present an offer price, which they're recommending. I usually we I think you should bid on these type of properties, so the price is always up for discussion. But here they have some indications. They have a cap rate, which is the uh, operating income over the value of the property. So what is it yielding per year? And here they have the pro forma, which is kind of like this is the pipe dream. This is what they're hoping for. So if they achieve the market rents or above or increased rents. So it's built 1955. It's 13,000 square foot. Got some a little bit of juice here on the property. Got some sales comps, got some location here. I don't know much about this location. I'm from the Nordics, if you couldn't tell, and it's quite from me, but far from me. But nonetheless, you can underwrite real estate taxes. That's the beauty of it. But obviously, market intel would come from someone more local. You'd have to have an operating partner, and that's where you guys come in. You can become operating partners. You can start sourcing deals, throwing these models to investors, and you guys can start providing that kind of value to people like I am, sitting far from the action. Okay, they have the rental income. This is the pro forma. This is what they're hoping for. They very nice kind of the broker to provide some estimates for this. This is obviously where you guys have to do your own property management. You can maybe include some leasing, whatever. You'll have to do it yourselves or hire someone, and then you get the cost yourselves. But okay, here we get down. We get some cash flow. Okay, they got some debt, but I don't care about their debt. We're taking up new debt. Here there are some key metrics. Okay, a disclaimer. Okay, let's just jump right into the model, shall we? Okay, this is a completely blank sheet. This is how I like to do it. You guys will go through it together. Just bang through the entire model, start to finish, and we'll have a beautiful time. So let's start out. Let's name this sheet the assumptions sheet. Here we shall include a lot of beautiful stuff. Let's add some more sheets here, shall we? I want a calc sheet. This is where, I mean, it's where the magic happens, as they do say. We'll have maybe we'll have a output sheet. Maybe we'll have a promote sheet. We'll see if we got time for this. This is where you guys can start making some money, some fees. Where you, if you source the deal, you can find an equity capital partner and you can catch some promotes. But let's see about that. Let's remove this and let's start working on the assumptions. Where I usually end up. Okay, let's start with the formatting. Obviously, most important thing for 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 all deals. Just kidding, but let's catch some business here. So okay, I like to try to keep it tidy, even though I think it's a little bit pedantic. But let's work like it like we know what we do, but maybe we don't. I'm not sure, but let's do some manual formatting here. This is very painful stuff, but let's get into it. Okay, we'll have property specs. Oh, I should remove my F1 key here, but okay, I'm obviously tapping my F1 key a lot, but okay, property specs. We'll have we'll have maybe we'll have some timing assumptions. We'll have some rental assumptions. Let's get into this, okay, guys. Let's get into the meat of this. We'll have some rental assumptions. We'll have some perhaps acquisition assumptions. Assumptions. I guess we got some debt taking up some debt here. You guys, you know me. We can get into more details if you like. You guys want to. All the fees, some value add case, some capex. We can get into it. We'll see where the time is, but you can also comment down below, and I'll provide more details in this regard. Okay, what I was saying, debt. Okay, let's take it up the depth. Let's try to keep this efficient. Let's get it like this, and um, mm, uh, then perhaps we need some capex, because I read that the commercial space was completely vacant and they needed some renovation to get it up and running. So that's where the value adds at. That's where we make the money. Okay, I'll just fill out with what I think we need, and we can provide the actual numbers from the investment memorandum. So let's say number of units, size, and you guys want to do it, of course, in square feet. I'm Swedish, we don't do feet, but I mean, I cater to you guys' preference. Um, Size, square feet. Yeah, I mean, I guess that's the main for crux of these kind of things. Um in terms of timing, acquisition, I guess um, we can do uh, redevelopment start, periods. I guess we'll have some time it takes to do this renovation. If we want to unlock this, we can do like kind of downtime in case of churn. So if a tenant moves out, it'll take some downtime to find a new one. We got some redevelopments, and it'll take some time, and we got some acquisition. And we also want to obviously exit this property. How long will we hold it? Maybe a hold period. We'll do like so, hold period and exit date. Yeah, this will starting to look up. Starting to look up here. We're getting down to it. Okay, we'll probably do so. Just I like to keep it. If you guys want to show your investors, you want to show your friends, your family, if they want to invest in these deals, you'll have to try to keep it bearable for them to see. So we'll try our best. We'll try our best. Okay, what are we saying? What are we saying? Okay, we can look at uh, for the rental assumptions. We'll go with the same as breakdown as they had done, where they broke it down per the units. So they had a type, they had a number, they had a size, they had in place, rent, and then pro forma. And I won't do this market rent thing there. I mean, it's broker estimates. I don't trust it too much. So we'll just go about it our way. So studio apartments, they have studio apartments. They have 1 bed. They have 2 bed, 3 bed commercial. They have 10 of these, 6 of these, 1. Then for the number of units, we'll just do some here, and I think it's 19 units. Okay, the square footage, we'll do the same thing. They got 450, 500, 600, 700, and 3,800. So for the square footage, I'll use this beautiful formula here with some product, because I presume this is given in the per unit size. So I mean, what's the average size of the unit? Let's see. I mean, it's this divided by this. Let's see. Okay, 663. I mean, what's that? Okay, 50. I mean, that's quite big apartments in my estimated. I guess it's more of a row house or something. 600, 650, 700, 750, 3,000. Okay, so you guys know we want to get to an NOI, a net operating income. So we'll just go operating expenses, and we'll have a hard plug for this. Okay, we'll have an okay. Let's keep our inputs in this kind of formatting here. Let's do it, and we'll see. Okay, what did they assume in their pro forma? Okay, I like to do this. I mean, it's a broker estimate, but we'll do a high level underwriting, and then you guys can get down to the business if we want to break this cost down. But we'll do high level start. Okay, they're doing 30.4. That's the start. So let's do it. Let's start with that. Let's trust them on that. This is a decent operating way to operate the property. And here, I think we can probably just do what is the rent. Let's do like this. Okay, just do rent and y, and then we can have in place, and we can have pro forma. Okay, this is just the product here. So we'll get into the calculation soon. This is just an assumption sheet. We're just setting it all up. That it'll go smooth sailing. We'll come to an IRR. We'll come to some beautiful stuff. So I think we'll look a lot better as we go. But we'll start by this. Okay, the rent is obviously this. This. Oh no, sorry. They do per units, right? They do per units. Okay. Was this the? Wait, did I do it this? Okay, whatever. Let's just do this. And pro forma, I didn't fill in the pro forma, did I? Maybe I messed it up. So here, yeah, maybe I messed up this one, but whatever. Okay, so they're saying we can get 3,000 for this. Okay, what do we have? 450, 600, 600, 600. Okay, that's what they have in place, and this is vacant. This is a little vacant thing, right? Okay, so this we'll just do so like so, and then okay, you can just whatever, you can just do like so. And here we gotta multiply by 12 because I want this on a yearly basis. this was likely on a monthly basis. So here we got the rent, and then obviously this times 1 minus the operating expenses, we get to the net operating income. So we're already a bit on the way. Then we can get some acquisition things. I heard they were targeting an acquisition price of, what was targeting acquisition price. This is a target. This is a thing you can flex. You can flex around. This is not a set in stone. You can negotiate with your brokers, but let's start with one too many zeros, I presume. Yeah, 1.3 mil. That's a decent size for at least a small investment company. Like if we were to start a shop, that's decent. Okay, the cap rate. Let's see what they have here. Obviously, they will get a little bit of lower cap rate because I think they're including a little bit of something, some of those um, utilities in their NOI. But we'll start with this. Okay, we're at 6%. I mean, are they 6.0? Okay, so they're a little bit heavy here. So we're a little bit lower. Okay, they got this year built. Okay, let's continue populating our stuff. What else do we want? We want some debt. We want loan to. Okay, let's see. Let's do. Do we want to refi? Maybe we'll hold this for. I mean, you guys can decide on when you want to hold, when you want to. Let's. I don't know about your guys' market. Let's see here, but I want to hold it for 5 years. Let's just do an acquisition financing. We'll keep the refinancing for another video to keep it manageable. But initial, okay, let's do LTC. Let's just lever up this property, and we'll do it at 60%. That's fair, quite opportunistic deal. We'll do some margin here. We'll do a margin at 2. We'll do a margin at 3.5%. That's a big margin, sizable thing. We'll do another sheet here like macro. We'll do here like, okay, freaking macro stuff, whatever. We'll do inflation. Inflation will, I mean, you guys know the worlds are changing, so we maybe have to change this up, but let's do inflation just flat at 2%. And I mean, obviously you could model it per year, per annum. Let's just keep it simple, keep it to the basics here. We'll do this is the what's called in the US the Fed rate. Yeah, let's do like the US Treasury bills. Let's say US Treasury rate. We'll do that. I mean, what is that now? I mean, yeah, let's do 2% as well to start off with. You guys can change these things up. I guess it's a little bit higher as of time of recording this video. Oh, the capex. Okay, when does it come in? Will come in at the same time as the redevelopment start. Okay, this was the wrong. This was the whole period of thing. But this redevelopment start. This might also take. Well, you have to talk to a construction guy or call up your friends. Get this actual. How long does it take? How much does it cost? But just high level, we'll do this. We'll do this a little bit after the acquisition. So here we got today. It's let's close this deal at the 1st of next year. This, as you can see by my dating down there, it's soon to be end of year. So we'll close that then. We'll exit it at the date that comes this, and then times 12 because it's in a month. And then I guess we'll do Alt HN and do this type of date here. I know you Americans use a different kind of date format, but let's try to keep it civil here. Let's try to keep it civil. Okay, so we redevelopment start. I guess this might be. I mean, yeah, let's do. Never hard codes, never hard codes. So let's do like um, time after completion, or time after acquisition, sorry. We'll start the redevelopment at 6 months after it. We'll do voila, we'll do like so, and obviously times, now this is just months, obviously, so we don't have to do, and this will do like so, okay. And then you know the drill. Let's just copy the format here and then do something like so somewhere like so. Okay, we got some things, and then okay, if a tenant moves out, let's have a 3 month downtime. We're quite fast, getting in new tenants. This is obviously important. Do we have any structural vacancy? I mean, let's see about that. Okay, we got our these type of things going on. Okay, we're starting to look up. We got our depth, we got our margin. You can break it down a little further. How much do we need? Okay, so it's a 3,000. How about big is the space? Okay, this space is 3,000. So development cost per square foot. Okay, let's break it down. Here you would call your general contractor, your friends, or maybe your a good crafty man yourself, and know basically how much it costs. I'll just eyeball it. Let's say it'll cost maybe $1,000 uh, per square meter, but you guys are using square foot, so that'll be divided by 9. So maybe $111 or something in your guys' ballpark. That's where I'd be at. And then, but yeah, I mean, this is just high level. I mean, I guess you guys probably 1,000. That's probably pretty expensive per square meter. But I mean, let's keep it like this. Development costs. This will be simply this and the. I mean, here we're renovating just the commercial space, and this will cost actually 420K. So 420 boys, but this will be, I mean, it'll be a sizable chunk of the actual acquisition price, but hopefully this will be enough to warrant the additional. So let's just check out what they do with their sorry about that, what they do about their utilities here. They got, how much is this in utilities? This is, I mean, how much is this in utilities? This is 1,400 divided by. So here I would call probably the broker, get a sense for, okay, what why is this exact number? But let's try to do it by like so. So utilities, and we'll still do 6%. We'll do 6% for both. Sorry, wait, was it 6? Yeah, 6.5 for both. Let's just get a ballpark sense here. We'll see whether the math be mathing. So let's just new NUI. This is just NUI plus this times this. Let's yeah, let's just see if the math be mathin, and see if the actual cap rate that they presented is this close to this one. This is actually okay. This is a little bit above. Okay, we'll see how they got to their cap rate. I'm curious. I'm curious as to how exactly they got to theirs. I'll probably talk to the broker, ask them. But let's proceed. Okay, I think we're on to where we can do some rent rolling stuff. We'll do some rent rolling. Okay, guys, let's continue where we left off. So let's go through this. Okay, we want to get to an IRR on the 5-year hold. Sorry about this. This five-year IRR. Okay, my computer has been lagging out. Okay, let's do it. We want to get to a multiple on capital. Let's start with these kind of measures. Perhaps we want to understand what the actual equity needed and stuff like that. But let's start with these kind of assumptions. So let's jump into the calculations. So I'd like to use some of the same formatting. Let's do this just out of simplicity. Okay, so let's just do so. We'll do the calculations in this sheet here. And what we want to start with, I mean, I'd like to do this on a monthly basis. So let's see if we can do that. Let's see if we can do it on a monthly basis. What do you guys think? So we want this to really permeate the entire thing. We want the kind of start date, finish date of a month. So let's see where is this at. The first month will acquire the property. This is the model start date. Okay, let's do it like that. And this we can do end of month here. Okay, months we'll do 0. Okay, so we'll probably have this month here. Okay, so we're starting to get the hang of it here, I think. Okay, and this we can just do one month ahead. Okay, the question is then obviously how freaking far into the future can we do this? So let's see this. Okay, we want to do it until the exit date. So, or I mean, we can do it just until, no, we'll do it until just like freaking do it. We'll do it live, as they say, we'll do it live. But yeah, we'll do entire model. We'll probably have a model end date, but let's just do 60 months here. All right, this is where we were at, 2029. I mean, let's do a little bit more just to get, if you have a a model that is slightly longer, we can have a little bit more flexibility here. But I'll start with these. Let's format this maybe in a different color or something. Let's keep it as is. Okay, we'll see how this shakes up. We'll do the like so. Keep it nice and tight. Okay, we'll do start with acquisition flag. And here, okay, I mean, okay, let's break it down into some sections. So acquisition and sale. We'll have that kind of sectioning. We can have maybe a section called the valuation. We can probably have like kind of a, I mean, we don't need a P&L, but kind of NOI stuff. I mean, valuation, probably NOI will be inside here. Maybe a depth one. Maybe a rent roll that is kind of feeding into this valuation thing. Okay, so we'll do the acquisition flag. So if this, I like to do it with flags, which is what I call, is it equal to, I mean, just with ones and zeros, so kind of binary programming here. We're talking, but kind of simple stuff. So let's lock this and just type times -1. Okay, so if this is and this is, of course, maybe you guys know a better way to do this, but I mean, I'll just populate this with whatever to keep it easy for me to go ahead later. Let's format that later, but let's just do so. Okay, we got this. And actually, I want to have a little space here, maybe some even more space here, where we can actually have all the sums here. So this will always be a good sanity check. Let's do another like so. So the sums here will be easy to get a feel for. Okay, so acquisition flag, we got the sale flag. This is basically the same thing. And we'll see, did I exit? Let's see if this is equal to this. Where is the exit date? Lock that times 1. Do like so. See that it sums to 1. It does. I actually want to have kind of and flags. Let's do it like this because we have a lot of flags we want to. If we want to do a real underwriting here, we gotta have some flags. Because well, guys, what we want to do is we want to get down to the free cash flow to the equity, and we want to see that on a monthly basis to get a good sense for the actual IRR of the case. And I mean, it'll take some details. So if you guys are in for it, we'll continue to plug along. But I think this we're doing a great job, and we're getting towards. I don't know, you guys. You can see any model. I can show you any model. I can send you any models later. But I think the building the thing is actually where the value's at. And you'll have to do a lot of customization to get a model working. So, okay, we got a sales flag, we got the operation, let's say operations flag. This is where how many months we're operating this thing. I mean, I guess this is the first month. So if if this is bigger or equal than this, it should be bigger or equal to the acquisition timing. Yes, of course, but they should also be uh, bigger, or it should also be smaller or equal to, no, this should just be smaller than the exit date. I mean, it's easy to do off by one mistakes here, but okay, I guess I forgot, or I mean, obviously I added some rows, so I guess that's where it's at. We'll see how long the actual operations is. We'll hold this for 5 years, that's 60 months. It checks out, must be mathing. Okay, any other flags? I mean, I'd like to have this inflation probably. Let's just check it out now. Just already, just like freaking pound that boy in. Inflation flag. I mean, I'll I'll keep it simple. I'll keep it simple. Keep the kids frisky with it. Just have inflation at yeah, we'll inflate the revenues already the first of this year. So if I don't know, no, never do if. I don't mean you can do if, but I mean here obviously you shouldn't be hard coding this, but I don't see a reason why we should be inflating any other months than January. This is how I underwrite cases. So we'll see. Okay, this month. How's it? Oh, sorry, I left the. My bad. My bad. Yeah, I left the month Canada. So how many Januaries? We have 9 Januaries in the entire, but whatever. This is not only during a hold. This is entire during the entire model period. We can do indexation here also. We can do the indexation here. I mean, this is simple stuff. Just do we'll just do here we'll do the kind of like so. J, and then we'll just do this note thing. I'll do like so to just remember that we got some hard code here, but we'll do this times this times uh, 1 plus, and we got a 2% inflation. But yeah, you can do this monthly on a yearly basis, uh, and then here we'll just do the same thing, but just to remember this kind of this times right, it's easier probably this plus this times uh, this, but then we'll obviously forgetting something times this, right? So we'll get some recursion here. Whatever, this will probably work out decently. We'll see about that. We'll see, does it inflate here? It Let's see if that so it should obviously inflate. Let's see. Okay, we got one here. Um, we're taking 100 and then we're adding 2%. Is it adding anything? Mm. Let's just start over. This one is right. Then we want to take if there's an inflation flag, then we want 2% of this. Let's just start with that kind of. Maybe I didn't lock it. Maybe that's why. Maybe I freaking didn't lock it. Okay, so we obviously want 2% of this thing if there's an inflation flag. Here there's an inflation flag, and we want and here, but we also want just this flat thing like so. And here we're starting to get some inflation. Okay, some indexation. I think I just forgot to lock some cells, but that's what happens. That's what happens if you try to do things a little bit fast. Okay, so we got the inflations. We're looking at here for the valuation. We kind of have all the most important flags that we want here. For the valuation, we want a rental income. We want some operating expenses. We'll see. Hopefully they'll cover. We'll have an NOI. We'll have a pro forma valuation. We'll have to obviously have some exit, acquisition, and exit assumptions. I mean, I think we can exit cap rate. We'll do it on a cap rate basis. You can do it on a per square meter basis. You can do it on per unit basis, whatever you like. But here we got the entry cap rate. But here the exit cap rate. I think we can do start by 6%. We'll see what we'll work up to. We'll see. They're saying that the entry is, but maybe I mean let's see how the things shakes out. We can see what we think we can sell the property for in the future. But we got the rental income, we got the pro forma valuation based on the 12-month rolling NOI. We're I think this will maybe suffice. Then we got the debt service stuff. I mean, we want some, I guess, cash flow here probably like here. Let's do a cash flow here. This is probably most cash flow to equity. Or let's do it here actually. I think undervaluation will make sense. Or, no, let's do it here. Sorry. For the valuation, let's do that for there. Okay. Cash flow to equity. Here we'll have some sources and uses, whatever. Okay. Things be thinking. Okay, and here we'll do. I mean, this is all. We'll also need some flags for this probably. Whatever. We'll do that next. We'll do the rent roll now. The easiest way to do this. Okay, so we'll have to know. Okay, we got rental values today. We need to know when are they kicking in for the new the market rent. Let's say, I mean, we'll have to churn out some of the guests. I mean, okay, let's just do in place kind of rents, and these will just be the rents that's today. We'll do it on a maybe unit per unit basis. So let's do okay, yeah, let's start off with doing it. We'll do kind of these different kind of units. We'll do studio, whatever they have. They have like the commercial stuff. we can uh, we can think of, okay, what do we want to, okay, we'll have to have the flag here. I mean, how long will it take? Maybe we'll do on a rolling basis. Maybe we'll do maybe here like time to achieve market rent. Maybe it'll take 6 months after this, maybe 12 months. This will obviously do. This will do at uh, at completion of the redevelopment likely. And but this, let's say 6 6 12 12. Okay, and then this will be the date diff between. I mean, yeah, this obviously we can just do like so. Also, it'll take 12 plus 6 months. Okay, so 18 months. Okay, so we'll do some flags here. This is a lot of flags. Flags be flag in. It's 6 flags. What you guys like? So we'll do the rent flags. Rent flags here. We'll do studio 1, 2, 3 commercial, and we'll do the market rent flag here. This is a market rent flag. Let's see. Uh, let's do a little dirty one. Let's do whether the date between this. Let's do date between this and the acquisition. Let's see. Okay, in a monthly basis. Let's see. Okay, this is 0. Let's see. Okay, this is probably the wrong direction to write this kind of stuff. So we'll see. We'll see if I'm mistaken on these kind of things. Okay, this is 1. Okay, so we got the date diffs here are checking out. So this, what was I saying then? Okay, I was saying, is this, the question is this larger than this? Is it? No, it's not, obviously. Let's do this like so, and we'll have this flag sorted out. We'll see if the flag checks out. We'll format this later, and hopefully, if we lock things properly, okay. So yeah, here, where do we achieve the market rents? Okay, wait, I probably didn't lock everything. No, wait, the date diff here. Wait, I didn't lock this one, right? Assumptions. Wait, I have to lock this one. Okay, here it's looking a little more crisp. So here after a couple of after 7 months, so I guess 6 months, and then at the 7th month we'll start having the the actual market rents, and here we'll lock this third one, right? Yes, this will be suffice, and then we should see a rain. But then I guess, yeah, I shouldn't have locked. Actually, this one should probably be only locking the actual, yeah, probably like so, right? So we'll get a nice kind of looking like a freaking beautiful Niagara Falls here. So okay, this is where the market rent kicks in. We'll just have to keep an eye on what is the market rent here. So So let's just keep track of that in terms of let's do the. I mean, it gets frisky if you do these kind of rent rolls with all the different units, but that's how if you guys want details and the things you gotta keep the detail high. So these are the market rents, the in place rents. Okay, why am I keeping track of these? I want to remember that I need to inflate these. Okay, so let's just do for the studio. Where do we begin? We begin here. For the studio, we can just start with the in place. This is on a monthly basis. Beautiful, beautiful. So we'll just lock the G here, right? So we can't move the like so, and we'll do it times this indexation flag. So we got some funky indexations coming in. 4,500. Okay, obviously we have to divide it by 100 also. It's a little big. It's a little big. Okay, it's looking like we're indexing it up. So hopefully we should be able to do the same here for the rest. Looks like we cannot. Let's see what's the issue at hand. Lock. Okay, we'll have to lock these ones. We'll have to lock it to 11. We'll have to see about this. Okay, looking absolutely marvelous. Okay, I guess the market rent was the same for these as or the in-place rent, and we'll do a market one. I mean, this should actually be kind of just to I mean, I guess we can just copy this whatever and do some adjustments, because instead will be okay. I guess it's not really vibing here, but I guess this will be, instead of G31, this will be the the age 31, and then we'll lock the age here. We'll see if that checks out. I mean, we got a little better terms here, I think. Okay, here we're looking real good. We're looking real good. We got a lot of rent coming in here. We gotta keep track of which rent to use here, and are we having any vacancies? I mean, let's keep it high level here. Let's keep the underwriting high level. We should all obviously in reality keep track of, okay, who's moving out, how long does it take, what turn does it take, how much does it cost. It's a lot of things you can keep track of if you want, but I think at this high level point we'll do just a chooser here or whatever. The rental income will be, let's do another flag. Let's do another thing here. Actually used or whatever. I know we're getting up there in terms of the things that we're doing, but I mean it'll be all worth it. It'll be all worth it in the end. I promise you. So here maybe you can do the if. No, let's not do if, but let's do this, because this is the flag. These are the flags. If this one is true, we'll have the market rent. But if it is not true, and I'm assuming either that it is either or either not true, we'll have the in place rent, right? Okay. Math kind of checks out here. Okay, we didn't have anything here. There probably, you guys can obviously write in the chat if you guys have a better suggestion. There's probably a lot of ones to get these things done more efficiently. But okay, so I guess commercial. Okay, we're letting out the commercial here. I think this is reasonable, right? We're waiting a couple of months. How many months? We're waiting 19 months, or yeah, after 19 months, the commercial will be let. I mean, this could be an off by one. We could say, okay, maybe after 18 months it should be let, but let's keep it like this. So for for the rental income, actually for the valuation, we'll just do the sum here for all these beautiful properties we're letting, and we got this. Yeah, what do we have anything here? Absolutely marvelous. Okay, so we're starting off low rent, low rent. What's happening here? We're getting up, we're getting up. Okay, the actual the commercial space is an insane build up here. It's actually that's freaking huge. Wait, oh, I forgot how many units we had. Whatever. This, I mean, this is not a big one because I'll just I'll just actually do times. This is obviously a big mistake from me because I'm a rookie with these type of things where when it comes to multifamily, where they have different units. I mean, well, I usually model industrial real estate, but let's check this out now. Let's I mean it's times 10, then we'll have to lock the E because that's where it's at, right? And then we'll do down, right? This is where it's at. What happened here? Did it not register? Okay, right. All right, I have to do it on the entire thing. My bad. I have to do it like so. With the parentheses are apparently important here. There we got. There we go. There we get. Okay, then the commercial spaces no longer look like a huge part of the deal. So okay, we got to make some checks, but things are looking a little reasonable. We got this times 12, this around the rental income we were having at the beginning, just with a little inflation. I'm assuming that the rents are indexed at 100% indexation. You guys can talk to your brokers, you can talk to your local guys. How are the rents in or the leases indexed in your vicinity? But in Sweden, we do it 100% usually. Okay, the operating expenses, we can simply do this times the assumption. We did it quite high level here. You can do it a little bit more granularly, but I like to keep it high level. Keep it high level when we do this kind of initial deals, initial screenings, and then just this divided by this, or this subtracted by this. I think we'll get a good high level underwriting here, and then you can go into more detail if you'd like. The 12-month, okay, here the pro forma valuation. I mean, you could do it all in one. I like to do it all in one. Let's try it. Let's try it out. We'll see if I'm able to do it. Okay, let's look 12 months ahead. Uh, I think we're looking one, two, yeah, let's do 12 months ahead. So like so. Then what should we lock? I guess if we do like so, yeah, it should work. Yeah, it should always work. So just looking 12 months ahead, and then you actually capitalize it by the exit cap rate. So we're buying it from one for 1.375, and then we get a little bit indexation, and that hits the NOI, and then we go up here. But you guys will see this will be an insane uplift when we get to the freaking commercial space here. The commercial space will be absolutely marvelous, I believe. When we get that let and we get to the market rents, this is where the property will start absolutely blowing up in value. Uh, yeah, I guess yeah, here it winds down in the end, but we go up to 2.4 million as at the max, so we'll double. This is a big, obviously a big uplift. Maybe we'll actually have we can see, we can tweak around with here, but I mean, to be conservative, maybe we could have it at 7%, which is kind of the reversionary thing. We'll see how stabilized we think our asset is when we exit. But let's get in the depth. Let's get in the depth. Let's get in the acquisition price, and then we'll have something flowing where we get the IRR out. So we're almost there. We're pushing the end here. We'll just get the depth flowing. So depth drawdown. We need a depth drawdown flag. When do we draw the financing? So here, if you were to have uh, refinancing, you would have to have a flag like that as well. But let's do like kind of financing flags. And you can hide the flags later if you like. If you want to, a little bit more uh, a little bit more or easy to view sheets. Okay, so the financing flags will do depth drawdown. When is it drawn down? Depth drawdown. And here we'll draw it just down in one freaking go. And this is just at acquisition. So this equal to whatever when we acquire the property. But I mean, I like to do construction financing and stuff. We could do it for the redevelopment. Oh, now obviously we need to model the redevelopment also. This one of the last things, but drip drawdown like so. Okay, so then we can also do depth drawn, and then we can do depth balance. Depth balance. We can do amortization. I forgot to have any amortization. I don't know how it's structured in the US where this deal is being made, but and obviously there's tax implications and stuff. Let's disregard this for now. Well, we got what was something? Okay, amortization. Let's do 2% annually. So debt drawn is this, the pro forma valuation. No, let's do it at cost. Let's do it. Outside LTC, let's do it at cost. Let's not do it. You can do it at valuation, or you can do it like from a cost basis, but I think this is more reasonable probably. Depth drawn this times, and you want to obviously have the drawn flag here. So it should only be at one point here. So we're drawing 825k. And then we obviously have this in the balance, but we can let's do it monthly amortizations. That's I guess what you would do in uh, in a household, regular household, likely. But so we'll do a monthly drawdown, and then this will just be this minus this. We'll draw a little bit down, or no, sorry, we'll amortize a little bit of the loan. So we'll get a nice. Wait, sorry, I have to do like so, right? This one works, yeah, yeah. So we're paying down the loan, and then we'll have to pay down the entire loan at debt balance. I mean this. Let's do debt repayments. Debt repayments. This will hit the cash flow, and it'll be this. I mean, obviously the amortization is a debt repayment, but let's say big debt, like let's say bullet repayment or whatever. Debt, we'll pay back the debt balance at exit, right? So we can just do so. I think that's a reasonable assumption to just pay it down, and then you can also this debt balance will just do minus. And will this be a reference? It will actually be a circular reference. So here you have to keep it tongue in cheek here. But the debt balance, I mean, it doesn't matter. But after this, it will be this should work, right? This shouldn't be a circular reference, but So what happens here? We amortize, we amortize, we amortize, we amortize. Then when do we exit the property? Here we exit the property, and then we pay off everything except this little teeny weeny chunk here. So let's. I mean, why would I do that? Is it just? I must have right, because this, yeah, this one, this debt repayment here, you're paying off 746. This together should be the remaining debt. Yeah, this is correct. Yeah, wait, this is almost correct. Yeah, I mean, it doesn't really matter here, but doesn't really matter about this. I mean, we should obviously pay back this. We should obviously pay this, and probably like kind of. Yeah, well, you should. Okay, like so. Okay, that's. I mean, mistakes do happen. I mean, mistakes do happen. I mean, this is you can't blame me. It's late in the evening. Late in the evening. You have to excuse these rookie mistakes here. But okay, so we got some cash flow here from the debt. That's we got some, obviously, of course, some interest payments. Let's do them monthly as well. And here we're approaching guiding light. We're approaching takeoff. We're approaching the one that we are looking for. So interest payments, let's do use treasury. I mean, you can do here why I put the treasury and inflation as kind of these numbers here is because I want to, if you want, you could have it year by year and break it down. That's how I would underwrite it if it be um transaction here. Let's block these. I always sometimes forget to block stuff. Let's at the debt balance you have to pay a 12th of it. Okay, so we got we got a lot of debt service here. Excuse me. Okay, this looks reasonable. We'll pay a little less all the time. Okay, so we're almost at the cash flow to equity. We got to do the capex one, right? We got to do uh, we got to do capex. Where did I reserve a spot for the capex? I didn't reserve a spot for the capex. How could I be so foolish? Let's do capex all equity. We could obviously finance the capex for the redevelopment, but let's keep it like this. Uh, development flag. Can I do all in one? No. Let's do development start flag, development end flag, development ongoing flag. I mean, I'm no expert in making all these. You could do it obviously in one go, but let's let's keep it high. Try to not make any more mistakes here. So are we? The development starts at what state does it start at? It starts. Sorry about that. Redevelopment starts here. Boom, times one. Let's just do all these, whatever. Boom, 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 boom. Let's check it out. With the functional love, check it out now. Okay, so we got a one flag there. Development end. I mean, this is similar stuff, but let's do it with. Let's lock it in. Let's lock it in. Development end. Redevelopment finish. Okay, it finishes in a year. I mean, and here we got to get this 12 months. We got to get. Uh, yeah, I mean, we could have just done it from the start. Sorry, guys. I'm sorry. We could have just done like bigger or equal than this. sorry, and then times 1 times this smaller than smaller. Let's do like so, and this should suffice. And we'll do the sum. We skip the sum a little bit, but here, okay, 12 months checks out. Okay, stuff checks out. Okay. We got the development. We'll just do capex cost, and we'll simply do this times, where's the capex? We got this, and then we just simply divide by the 12 here. Oh, this we lock, and here we should be game. Maybe we should have some inflation on this. I don't know. Let's have a check here. No, guys, no checks. Checks and balances, right? That's what keeps the United States so beautiful. All the checks and balances in the government. Let's see. Let's see that the sum of this is actually the same as the sum of same as this. Okay, it seems like we have a winner here. We have a winner actually. So yeah. Okay, guys, we're getting into the last push here. We got the capex. We got everything. We got most of the things here, right? We're going to the cash flow to equity. This is actually the most important thing. While live cash flow to equity last. Okay, we'll see about that. I mean, what are we paying for? What are we paying for out of equity? I think we're paying for capex. We're doing capex. These are kind of the negative. These are kind of the negative things, but we'll also have some depth drawdowns. Let's schedule it in another way. Let's simply do something. Okay, here we got some revenue. We got some depth drawdowns. This debt repayments, and we'll do some interest rates. We'll have some sales proceeds here, and we'll also have some acquisition costs. I mean, we're not including any transaction costs or anything, are we? No, we're not. So let's see if this is a decent cash flow to equity. Let's see if this is a decent thing. Let's try to get a beautiful thing here, because this is what we're really looking for. So we got the revenue. I mean, did we got the thing here, right? We got the OPEX. Let's just do it. I mean, now we're getting into the freaking. Let's do the CAPEX as a minus also here. Minus this. Let's do debt drawdowns. I mean, let's do debt drawn. I mean, this is probably this. Let's do minus debt repayments. Let's do this minus amortization. I'm very sorry. And then let's do interest rates. Let's also do a minus. I mean, this is not important stuff, but I'll just do a minus here to keep track of which are positive and which are negative. So the sales proceed will get the pro forma valuation at the actual sales date, right? But we'll get only the acquisition costs. Maybe we should have kept them something here, but whatever, acquisition flag at the actual time of acquisition, and we'll get this. Okay. Things are looking up a little bit. Let's keep the formatting crisp and clean. Let's do a sum here. Let's see if we can get some magic here. guys. Let's see if it just rolls off the tongue here, or if we gotta do a little bit of a CPR. Let's see if CPR is required, or we're just rolling with it. Rolling. Okay, so we're cashing in. Okay, here. Wait, here. Okay, we're drawing down equity. This would be a minus, my friends. This easy mistake. Say we're drawing down. Uh, is this a six? This is probably a 60% LTC then. 60%. So always do some sanity checks so we get some revenues and those increase. Our cash flow to equity here is very low. Then we get a good negative chunk here. Okay, we're doing some capex. Yeah, we're splitting it evenly. Capex is over here. Okay, looks kind of reasonable. And let's check for the most important thing. Are we selling the thing at the end? Yeah, we get 1.5 in the bank. We're paying off some debt here, I guess, servicing the debt, and then getting 2.25, baby. 60 G's, baby. Dana. Okay. Let's see if the XIRR does actually give us some reasonable stuff here. I mean, do we have to give a guess to these little rascals? Wait, wait, I should probably do it. My bad, sorry. Because I was like, why are they? Oh, this is after our hold. Okay, yeah, whatever. Wait, this is after our hold. I've obviously fucked up. Oh, sorry, YouTube for the profanities I'm getting. What is this? This is the rental income. Okay, let's just keep track of what during our hold also. So we'll keep track. Obviously, we operation flag. We forgot to use it. Easy mistake. Easy mistake. I guess that's what happened. So let's see if everything exits at the same time here. I mean, here is the last. Let's see that the Last of Us. Yeah, I guess the last month. This is reasonable. Wait, yeah, wait. I have to. My bad again. We'll have to do one for the perform. Oh, wait, where is the performa? Okay, we'll have to do one for the performa and one for the actual thing. So here is the. Yeah, I now understand. I must do this here, right? So sorry, the perform evaluation needs to be done this way because it's looking forward, but at actually here we can just put the flag. That's how it's most easily done here. The operation flag here, and the same thing for this one. Operation flag. Okay. Operation paperclip. You know about that. Watch any. Okay, so things are looking up a little bit. So let's see that we exit everything at the same kind of time. So yeah, this looks reasonable. I mean, we probably don't get any rent when we sell it. Let's say that goes to the seller. Let's say like that. Okay, we get 1.5. This looks like a good thing. So it looks like a reasonable deal. Well, we can do like so, and the dates are all the here, and then I guess we get some zero or something. I don't know. I mean, this is reasonable. We're getting a reasonable kind of return here, 14-15% for a real estate transaction with a little value add component, quite a big value add component because we need to let the thing out. I mean, I'm not loving it. I'm not loving it. I'm not hating it either. I'm not hating it either. Maybe we need to get a little bit more juice. We need to understand how to get there, but let's see on the multiple on capital. Let's see what is the actual act. Let's see, because here to end this off, guys. Thanks for really taking this time. Let's just end it off with some of the most important metrics here. So let's go accumulated cash flow, because here we want to see where are we in the trenches. How done bad can we be? Okay, so we'll just do this and do this plus this. So this will be kind of an aggregation operation. Let's see. Okay, yeah. So we peak here at, yeah, whatever, 940, 940. That's reasonable. I mean, uh, I guess I guess we got a pretty big capex expenditure. So it seems reasonable, right? What was our capex? I mean, what just high level what we imagine. We got 420 blaze it, and we got 60% of this. So yeah, we got 1 mil basically, and that's what we're looking at. So equivalent cash flow, max equity drawdown. So here we got min of all of the max equity cash flow. So we know it's 940. And then if you got some investment management fees or anything, investment management fees, you'll use it based on this here, maybe a flat percent, 1.5% a year for this here. But no, we don't. We're not having any equity management. Okay, so we'll do a multiple on capital. I guess here is the IRR. Let's do multiple on capital, which means how much how much are we turning over the capital. Let's see. So you can do it a couple of different ways. I would say it's probably most easy to do like this. We'll just do the actual entire freaking cash flow thing. We'll get probably 7/7 this. Then we'll divide that by this max equity drawdown, but just keep the flag right. So here we get the 1.0.8, but then you gotta remember that we're actually putting in the money. This money we're actually putting in and getting also back. We're getting both it back and whatever. So we got to do it like this, and then you can do a little whatever, blah blah blah, like so. Get it nice and crisp, and then we're kind of in the ballparks here. We're getting to the goal here, finishing it up. We'll do the custom formatting here. Custom formatting. We'll do like we did before, whatever, like so. Okay. So what's going on, guys? This is the end of the video. Thanks for taking the time to watching all the way through this. We skipped the promote, we skipped the output. I mean, it got a little windy at the end, it got a little long. So I'm saying, okay, let's just keep it like this. This is how you underwrite this kind of real estate transaction here with these beautiful, beautiful buildings that we didn't even didn't even look at during our underwriting. We just simply went through the Excel. This is a financial engineering. We didn't even look at the comps. This would be a good thing to do. And next steps, look at the comps, look at the what's what the market rents are. Okay, how do we deal with tax in this neighborhood, with this area, in this region of the world? So get to do the due diligence, talk to the broker, call him up. Let's settle this deal, find a capital partner, and then you'll go into these promote things. You go into these management things. You'll show some outputs for your LPs. That's all the stuff you do. But I think this will suffice for this video. If you guys want to see more, please do comment down below, and I'll try to meet your demand and show you some other real estate transactions. Let's get into it, and thanks for watching.